Welcome to the SouthBuy channel. Here we try and find stocks that don't get much airtime, and we teach how these companies can be valued using standard valuation methods like discounted cash flows. Today we are looking at WideOpenWest with the ticker WOW. WideOpenWest is a company that would have benefited from COVID lockdowns. Its share price has taken a hit in 2022. But WOW is trying to navigate the customer's choices while maintaining profitability. They are working on maintaining and expanding their network of high-speed data. Customer needs with regard to streaming and data are changing rapidly. All WOW needs to do is position itself for the future. WOW's share price has dropped 40% since the end of 2021. I explore the bull case for WOW as the current price action might be a buying opportunity. According to WOW 10Q report, they are a leading broadband services provider offering high-speed data which call HSD, cable television which they call video, and digital telephony which they call telephony services to residential customers, and offer a full range of products and services to business customers. Their services are delivered across 14 markets via their advanced hybrid fibercoax network. Their footprint covers certain suburban areas within the states of Alabama, Florida, Georgia, Michigan, South Carolina, and Tennessee. At June 30th, 2022, their broadband networks passed 1.9 million homes and businesses and served approximately 536,600 customers. WOW's three main lines of business are showing various levels of growth and decrease over the last 12 months. They measure subscriber and revenue generating units, which is called RGUs. RGU is a sign of how many customers are purchasing not HSD only but also other services from WOW. Subscription growth has been steady, but most of the growth is in HSD. The pressure on their video business also makes sense, with the exponential growth in streaming services over the last 2 years. From a cable perspective, they resell HBO, Showtime, and even NBA Pass. They also provide a service where you can package different streaming services together for a single price. From an HSD perspective, they are investing in providing speeds going up to 1 gig per second. Their strategy is broadband first, so the other services are value adds on top of the HSD. Even though revenue has dropped by 3.4% year-to-date, their HSD revenues are increasing. With their sales mix changing, they have done well to improve margins from 34% to 39%. Due to this shift in mix and their broadband-first strategy, they have put work into reducing their programming costs. Trying to sell the most profitable video services will be key to their success in the next 3 to 5 years. 2022 has seen the end of lockdowns all over the world barring 1 or 2 countries. This has negatively impacted the revenue and profits WOW has been making. The demand for streaming services and reduction in cable TV, this has resulted in pressure on their video business. WOW works on a monthly subscription basis, and revenue in the HSD segment is quite consistent. With its broadband-first strategy, its revenue mix will change over time. WOW's main aim appears to be to build a profitable business around HSD and pay off debt at a quick pace. WOW is a low-margin, high-volume business. Towards the end of 2021, WOW sold 9 of its service areas that did not fit the broadband-first strategy. Therefore, the drop in revenue in 2021. This resulted in net proceeds of $1.8 billion, which was mostly used to reduce their debt. WOW also refinanced with a credit agreement in December of 2021. This had a significant impact on their business considering the reduction in revenue. WOW will need to make some bold decisions to turn things around and reduce debt. Let's compare WOW to some of its peers in the industry. The current PE ratio of WOW is 1.7 compared to a peer average of 15.6. I believe this means that a bullish case can be made. The annual earnings growth expected is only 2.9% according to analysts. They do face many headwinds, especially with a highly leveraged balance sheet. Reducing leverage while maintaining profitability has been key. Their performance in the last year has been phenomenal compared to the industry. The market is waiting to see if it can hit its targets and reduce its debt. It is my view that the WOW targets are achievable and that they exceed these market expectations in the near term. Purely comparing the WOW PE ratio to the average, we can see that they are underpriced versus its peers. All WOW must do is start growing its revenue. The target they have communicated to the market is 2.9%. Definitely achievable for this business. I believe comparing them to their peers, WOW is underpriced. Looking at the above analysis, we need to corroborate this valuation further. We will do this by comparing it to the industry and performing a discounted free cash flow model. Compared to the entire US cable and TV sector, I believe they are undervalued. There are very few companies with PE ratios over 30. TechTarget with 131 and Starbucks with 32 are the only two. This industry is going through significant changes. But there are still plenty of opportunities to make profits. The larger market cap companies in the industry are around the 10 PE ratio mark. The industry is remarkably diverse. Companies like TechTarget provide marketing solutions to clients. Starbucks provides payment solutions to retailers. I believe that there is an upside opportunity for WOW. Compared to competitors in the larger sector as a whole, even though the sector is quite diverse, the PE ratio shows that there might be some opportunity on the upside over the next few years for WOW. This valuation method looks at growth factors and discounts with a suitable discount rate. We take the analyst's forecast from various websites like Yahoo, TradingView, and Simply Wall Street. The calculations below outline how an intrinsic value for WideOpenWest is derived by discounting future cash flows to their present value using the two-stage method. We use analysts' estimates of cash flows going forward 10 years for the first stage. The second stage assumes the company grows at a stable rate into perpetuity. This is the WOW valuation. A target of nearly $19 seems achievable. I use aggregate of analysts' expectations and apply a reasonable growth percentage for year 3 onwards. All WOW must do is become cash positive and produce small growth in subscribers over the next 3 to 5 years. If management can deliver on their strategy, they could realize this potential upside of 22%. There are downside risks which we need to discuss. WOW management team has an average age of 60. This could result in many executives being close to retirement at the same time. The team has an average tenure of 2.8 years, which means this team is the team that has been turning things around. Teresa Elder, current CEO of WOW, has experience in the broadband sector, even serving as CEO of Vodafone Ireland from 2005 to 2007. This team is making brave and bold decisions, and that's exactly what WOW needs. A sizable part of WOW's revenue is in video. It covers cable and sells custom packages which include streaming services. Their broadband-first strategy is trying to address their revenue mix issue, as other streaming services are going in-house or raising the hosting of their programs. WOW has been actively managing how much they pay for programs and only hosting what is profitable. This has contributed significantly to its margin expansion. Their balance sheet is still highly leveraged. This is the most significant risk with regard to WOW. They have sold some of their service areas to reduce debt significantly. This has resulted in a reduction in its debt-to-equity ratio from over 300% to a more manageable 122%. So to conclude, WOW leadership has had to make some tough decisions in the last year. They have done this and still was able to maintain a stable number of subscriptions. They are investing in new regions in the US as well. I believe in the bull case of WOW. Perhaps a better time to purchase some shares is after 2 or 3 quarters. They need to prove to the market that they can generate some healthy cash flows. Just keep them on your watch list, they might just surprise us all.